SuertePanda.com. Welcome back. Today I just want to go over an older concept from a book called Campaign Trading by John Sweeney. I don't see a lot of people talking about it, but I guess I want to just like bring it to your guys' attention because I think for me it was a pretty interesting concept when I first learned about it. I figure I want to see if I can maybe resurrect it a little bit. One of the concepts that really stuck with me was the concept of maximum adverse excursion because at the time I was trying to figure out what's the best way to kind of protect profits and where to place stops and like how far away should we maybe sell options and to try to like see if there's any ways I can improve upon the some of the tasty trade mechanics that are available. Because usually, uh, currently, based on the current research from Tasty Trade, the way that they like to do it is to sell from I guess like from an overall return on capital perspective, like the one standard deviation strangle is the way to go, and you always want to, I guess to get the most bang for your buck. Like ideally, you want to sell it on stocks or ETFs or any other underlying that has like high IV rank percentile, um, and that should give you some some at least a chance at really good profits. And the thing is, just bring it to the phone quick. As you can see, um, previous videos, like it's just like kind of my guess on what could happen to the ETF. It's really popular, and I'm just like just crater right away. There's a little things that bothers me about the overall market. There's like new people. I really don't want them to get hurt because that affects the liquidity later on. Those things are out of my control. But what I can do, kind of control myself, and take careful risks. So that's why I kind of wanted to start it in the RK ETF, and I'm gonna be adding on to this like long and short because I think there's a lot of opportunities. But rather than just like sell, right? Because strangle management sometimes can be a little bit game, especially on like the call side. It's for stocks that keep going up and that keep going up. It's almost like the the short call list. Um, mm, let me just show you like what I'm thinking. Like right now, like he was pretty good at one higher end of the range. Um, and then like the current price is roughly high. And I was just thinking, honestly, what would happen if there was a reaction? Um, you know, when I say correction, I mean like at least 20 to 25%. Simple. Let's just take 1/4 of this. So 1/4 of 124, about $31. So there's a $31 drop from the current price. So that would bring down the 93 level, and the strikes like in the arcade as I mentioned last video was a little like are different. So then the adjust for that. So I mean 92.96 is the the how do you say it the closest to what I'm thinking, but this is big. If I want protection, we'll have to pay about $1,000, assuming I can get full delivery price. So it's like 10 points for $1,000 and $1,000. If I wanted to just buy protection, assuming you already had a long position, um, at, let's just say the current this current price over here, 149. Um, and that right now it seems like a great time to buy. It seems a bit expensive. So let's just bring you over to like the spreadsheet that I have open. And it might take a little, like I've had a little bit of some some technical issues, so it might take a while to come up. So I think it's here now. Um, and just to go back to the concept of maximum adverse correlation, you really want to try to figure out how far you're willing to let